Assalamualaikum warahmatullahi wabarakatuh to everyone. We are a group of students from 2E, and today we will be presenting on a topic that plays a vital role in the Malaysian economy, which is finance for small and medium-sized entities. Before we begin, allow us to introduce our team members. I am Ajwa Aisyah, together with Athirah, Amira, and Nuraisya, Adila, Fasiha, and Fatin, Syafiqah. Small and medium enterprises, SMEs, are businesses with a limited scale in terms of employees and annual turnover. They form the backbone of most economies, including Malaysia, by playing a vital role in job creation, innovation, and economic development. In Malaysia, SMEs make over 97% of total business establishments, contributing significantly to GDP growth, employment, and regional development. Their flexibility, adaptability, and entrepreneurial nature make them key drivers of both local and global market dynamics.
Today, I would like to talk about the characteristic and role of SME in Malaysia. First of all, SME are mostly family-owned or individually managed businesses, and they tend to have simple structure with fewer layers of bureaucracy. Because of that, they can make faster decisions and adapt more easily. Most SME in Malaysia operate locally or domestically, and they often face limitations in terms of access to capital, technology, and skill talent. In terms of sector distribution, SME are found in almost every industry. For instance, they are active in manufacturing, services like retail and F&B, ICT, agriculture, and also construction. This shows how SME support various parts of the Malaysian economy. In terms of how they operate, they are flexible, cost-effective, and very customer-focused. They usually build strong personal relationships with their clients and often serve niche market that bigger companies may overlook. Now, moving on to their role in the economy. SME contribute more than 38% to the country's GDP, and they account for over 85% of total business establishment. More importantly, they employ around 70% of the total workforce, especially in rural and semi-urban areas. In other words, SMEs play a big role in creating jobs and providing opportunities for youth entrepreneurship and skill development. Moreover, SME are important drivers of innovation because they can quickly test and adopt new ideas. They help promote an entrepreneurial mindset and encourage more people to take risks in business. On the other hand, while their export share in relative small, about 17%, many SMEs support large firms by supplying goods and services in the value chain or through subcontracting. Finally, SME help with inclusive development. They reduce the gap between rural and urban areas and give more opportunities to the Bumiputra community to participate in business. All in all, SME are not just a small businesses. They are a key players in the growth and inclusivity of Malaysia's economy.
One of the main reasons why many SME face difficulties in securing bank credit is due to poor financial management and a weak credit profile. This means that banks often see these businesses as high-risk borrowers. They may lack proper financial records, have little or no credit history, or operate informally without a clear business structure. All of this make it harder for banks to trust that the SME can repay the loan. To help us understand this issue better, we broke it down into 3 key problems, which will be explained in the next few slides. First and foremost, it is because the lack of proper bookkeeping and accounting practice. Many SME with poor bookkeeping do not have proper documentation of income and expenses to have an up-to-date financial statement, making the bank cannot determine whether a business is financially healthy and capable of repaying a loan. This means that many SME do not keep their financial transaction properly. For example, they don't keep receipt, invoice, or track of how much money comes in and goes out. As a result, they don't have an up-to-date financial statement like an income statement or balance sheet. Next, without proper bookkeeping, SME cannot provide historical data to demonstrate year-on-year performance. This makes it hard to prove that the business is profitable and lead to the inability to demonstrate business growth or stability. When the bank looks at their business, they cannot see if it's making money or losing money, Without clear financial record, the bank can tell if the business is strong enough to repay a loan. Lastly, bank use financial ratio and financial projection to access repayment ability from the data of the financial statement. If the SME has incomplete financial record across year, the bank cannot compare ratio year to year. This is because bank use financial ratios such as leverage ratio to understand if the business can repay the loan. They also look at financial projection to see if the SME is expected to grow and stay profitable in the future. But if an SME financial record are not properly kept across multiple years, the bank cannot compare ratio from one year to the next. This make it impossible for them to track performance over time or see financial trend. Next, let's talk about poor credit history as a barrier to bank credit. This refers to SME that have bad repayment record or no credit record at all. When bank evaluate loan application, they check the SME credit history using credit reporting system like CTOS or CCRIS. If the SME has delayed payment, unpaid debt, or previous loan default, this will show up and negatively affect the credit score. A low credit score signals that the business is high risk. Even if the business is now financially stable, past issues still influence the bank decision. If the SME has no credit history at all, the bank also find it risky because they have no way of knowing whether the borrower is responsible with repayments. Either way, it makes the loan harder to approve. Lastly, we have unclear business structure and informality. This happens when SME are not formally registered with SSM or when their business documents are not complete. Some may mix their personal and business finance or don't have a clear separation between the owner and the business. Banks prefer to deal with businesses that are officially registered, legally structured, and supported with documents like business registration, financial statement, and tax record. If the SME operates informally, the bank finds it difficult to access the business stability or repayment ability. Also, informal businesses usually don't qualify for government financing schemes and miss out on subsidized or low-interest loan opportunity, which were designed to support them, such as SME Bank or Tekun. Because of this, even successful SME may face rejection if they don't have a proper legal structure. Together, these 3 points explain how poor financial management and a weak credit profile create obstacles for SME to access funding.
So now let's move on to the next reasons that lead to the difficulties and obstacles faced by SMEs in securing bank credits. The next one is lack of collateral or insufficient tangible assets. To explain this, the challenge for SMEs, which is limited collateral. Bank favor secured loans which are backed by assets like property or machinery. This collateral significantly reduces the bank's risk. However, many SMEs, especially newer businesses, services-based companies, or those renting their premises often lack the high-value tangible assets needed to provide sufficient security. So why secured loans are a hurdle for SMEs? Banks prefer secured loans because the collateral like property, equipment, inventory acts as a safety net, minimizing their risk. The problem? Many SMEs, particularly startups, service businesses, or those without own property, simply don't have enough valuable assets to offer as collateral. Now, understanding the collateral gap for SMEs. For banks, secured loans are the gold standard. They come with specific assets like property or equipment as backup, reducing risk significantly. But for many SMEs, especially new ventures, service providers, or businesses operating out of rented spaces, they often don't possess enough high-value physical assets to meet these collateral requirements. So, to explain about lack collateral or insufficient tangible asset, there is three main points here. First, limited access to secured loans. The collateral conundrum for SMEs. Banks prefer secured loans because specific assets pledged pledged by the borrower act as a safety net, significantly reducing the bank's risk if a default occurs. However, many SMEs, especially service-based, early stage, or those in rented spaces, lack the high-value tangible assets like property or machinery that banks require as collateral. This absence of acceptable security severely restricts their access to standard secured loans. Next, higher interest rates and less favorable terms for unsecured loans. Unsecured loans, which is a costly alternative for SMEs. When SMEs can't afford collateral, banks might still provide unsecured loans, but since there are no assets to seize if a borrower defaults, these loans are inherently riskier for banks. To offset this higher risk, banks typically charge significantly higher interest rates, impose stricter repayment schedules, and often demand personal guarantees from business owners. These less favorable terms can quickly make the credit unaffordable or unsustainable for the SMEs. Last one, difficulty in scaling operations requiring capital expenditures. Capitalizing on growth, a collateral catch-22 for SMEs. Many growth opportunities for SMEs like buying new equipment, expanding facilities, or investing in advanced technology demand substantial capital expenditure and consequently large loans. The problem? Without the ability to use these new assets or enough existing ones as collateral, SMEs struggle to secure the necessary financing. This directly impedes their abilities to scale up, modernize, and compete effectively, often trapping them in a cycle of limited growth.
Lastly, the reason why many SMEs face difficulties in securing bank credit is due to complex loan procedures and high transaction costs. Let's break it down into 3 key points for us to understand better. Firstly, one of the biggest challenges for SMEs when applying for bank loans is the lengthy and bureaucratic process. Usually, they have to go through several stages like submitting documents, credit evaluation, and getting approval from bank management. All of this can take weeks or even months. For small businesses that need funds urgently, this delay can really hurt their operations. It might even cause them to miss out on important opportunities or struggle to keep their cash flow steady. Next, strict documentation requirements. Banks also require strict and detailed documentation before they approve any loan. This includes audited financial statements, tax records, cash flow projections, and business licenses. But the reality is, many SMEs don't have proper accounting systems or enough financial knowledge to prepare this document. Without complete and reliable records, banks see these businesses as too risky. This often leads to the loan being rejected or only partially approved. Lastly, for the last point is high administrative and processing costs. Besides the complicated procedures, the cost of applying for a loan can also be a big burden. SMEs often have to pay application fees, legal documentation costs, and sometimes even charges for valuing their assets. For small businesses, these costs can be quite high compared to the size of the loan they are applying for. And even worse, if the loan is rejected, they still have to bear all those non-refundable costs. This put extra financial pressure on the business.
Okay, masa mula-mula berniaga dulu, guna duit sendiri ke ada pinjam dari mana-mana?
Duit sendiri, modal sendiri.
Okay. Next, apa nasihat nak bagi kat orang lain yang nak mula berniaga kat pasar malam tapi tak cukup modal?
Buat pinjaman kerajaan, ada buat pinjaman amanah Athirah ataupun tekun.
Okay, itu saja. Terima kasih.